Welcome, everyone. I'm Angelo Robles, and normally on my more public platforms, I'd say welcome to Family Office TV. And maybe I'll do some clips and aspects of this will make it there, but this is more of a private Zoom. There's a benefit to being invited and being interactive at the moment. Mainly, you hear it at the moment or see it, and you can interact with the guest. I may also distribute this to some of my members and family offices that wanted to attend, but again, the day and timing just wasn't right. But this is not for quote unquote broad consumption. This is going to be, for the most part, educational about something you all want to hear. I know I do, and dear to my heart, the VC community. But many of you mentioned, Angelo, we're big boys and girls. We're family offices. We're at minimal, I would hope, a qualified purchaser. We also know that you get incredible access and opportunity. I've been in this community a long time. I've traveled the world. I know thousands of people, and I literally get opportunities every day. Are most of them specifically good? No. Well, what do you expect? But some of them are incredible, that really sometimes only a very, very tiny percentage of non-massive institutions will even have a level of direct access to. So we're going to be a little bit more active from that perspective. Simply stay tuned. Make sure you follow me on all socials, reach out to me. And really, you want real access and first opportunities with what I'm talking about, become a member of my SFO continuity. On that note, let's get to it. So we're going to do 2024, the year ahead in VC. We do not expect this to be a multi-hour conversation. We're not going to cover everything. We'll likely be all wrapped up within 1 hour, and we will do audience interaction and questions. However, what we will do on that theme, especially in the first quarter, perhaps heading into the second quarter, is be consistent, covering a variety of topics broadly in investing and perhaps specifically in VC. So our special guest today is, again, a long-term relationship of mine, Justin Caldbeck. He's an American businessman, financier, philanthropist, and, of course, a Silicon Valley VC. Oh, we were catching up beforehand for those that didn't maybe hear the recording. He also played for a relatively well-known coach. You may know him as Coach K at Duke basketball, but he wasn't finished with his education there. He had to, of course, go to Harvard Business School, where, of course, he did incredible because he's a really smart guy. And then an East Coaster, a New Englander, like where I am now. I'm not in Wyoming, I'm in Connecticut now. He's a New Englander at heart as well, but he got his butt out of the cold and he went to Silicon Valley to do his thing. And when I was talking to him a week ago about, come to Wyoming or come to even Lake Tahoe, he's like, Angelo, I grew up in enough snow and cold. I may want to visit it here and there, but no, I'm not doing that. But Justin, welcome to the show.
Thanks, Angelo. It's great to be here, and I'm looking forward to the discussion.
Let's get right to it. What I hear from families, I'll start with a bit of a negative question from some perspective. Is venture capital in kind of a downtrend right now?
I don't think, first of all, would it be helpful to give a little bit of my background leading into that, just so people have a sense?
Yes, of course.
And then I'd love to answer that because I certainly don't believe so. So my entire career has been, when I graduated Duke, I went to McKinsey, started consulting for tech companies before Harvard, and then right out of business school, started investing almost 20 years ago. So I was at Bain Capital Ventures in Boston, still in the cold weather, from an analyst up to a partner there. And I moved out west, not exclusively to avoid the cold. I moved out west because, to me, I wanted to go compete for the best companies in the world. And at that point, I still think largely to this day, but certainly in 2008, the best companies in the world were largely centered out here. So I moved out alone for Bain Capital Ventures, built an office out here, worked on the early investment in LinkedIn, ended up hatching a company called Bloomreach, which is now about a $2.5 billion company. And then I got recruited by Lightspeed to be a partner there and really co-lead their consumer tech investing practice, which had not seen really any success before that period. They had been incredibly successful on the enterprise side, but no real consumer hits to date. And so I went there and helped build that. I led the early investment in Grubhub, sat on the board, took it public. Led the early investment in Stitch Fix, sat on the board, took it public. TaskRabbit was a number 2 on the seed investments in Snapchat and Affirm. And then was also doing a lot of angel investing. So in cases where I couldn't get them excited, I did it myself. Things like Uber, Open Door, SpaceX, Collective Health, etc. Launched my own firm in 2014, raised about $300 million for early stage consumer tech focused investments, and left in 17. I've been doing angel investing for a while. So in the last few years, was the first investor in Whatnot, which is now about a $4 billion live stream shopping company. First investor in Eightfold AI, which is a couple billion. And now I run a seed fund that invests globally around the world. And so, it's interesting when people talk about, is VC on the decline? It kind of makes me smile a little bit, because I think it's important to look at these things in context. So certainly relative to, the ZIRP era of 2020, 2021, right? Zero interest rate era. Things have been pulled back, right? You've seen many aspects of the VC market that have corrected a little bit in the last couple of years relative to those highs, right? So if you look at, last year, we were doing towards the end of the year kind of 30-ish billion a quarter of investing in the US across about 1,500 deals. That was about a third of the peak in 2021. Okay, so it's pulled back.
Mhm.
But relative to, if you look 15 years ago, it's up 6, 7x.
Wow.
So you've seen incredible growth in venture capital in the last 15 or 20 years. And I think, if you look at, if you look at, we can get into it later in the show, but if you look at the returns by really any time period over the last 25 years, it's been an outperformer. And so I actually think right now is a generational opportunity to be invested. You've seen some pullback to more healthy valuations. You've seen more of a focus on profitable companies. And yes, you're going to see some continued carnage from the 2020, 2021 era, where companies raised at massive outsized valuations and are going to have trouble living up to those. So shutdowns will continue. But I think in the long term, if you look at the trend line, venture is still very, very much in its early days.
And you worked at giant firms like Lightspeed, and I would probably even classify to some degree Bain
No
in that
question.
perspective. And other theme that I hear that, again, may have a grain of truth to it, but I think gets overblown, is that, there's, I don't know, buy into Big Blue, there's safety in the giant top 3, 7, 10 firms. I'm sure they're wonderful and they do great things. I'm in Greenwich, Connecticut. I understand more the hedge fund community. I don't know, Justin, from my perspective with hedge funds, I have great respect for the intellectual rigor of the PMs. Some of them are friends of mine, and some of them do a great job. A lot of them make a hell of a lot of money. They often take the summers off in the Hamptons, but besides that, they also are kind of asset gatherers. They have so much money that they placate to institutions only. A family office giving them even less than 50 million is almost a laugh. They're probably going to give it to a junior associate at best. I'm being a little tongue in cheek, but that's for the most part true. And they also, it's harder to move the needle on certain specific opportunities. So they basically kind of live off a lot of that 2 and the 2 and 20 and look for probably a level of more consistent returns. I know VC is different, but whether it's a 10 billion VC or a 10 billion hedge fund, there probably are some similarities in the management style that I described.
I could not agree more. Look, I've lived it. I've been at, I think, some of the largest now blue chip firms in the space as a partner, from a junior analyst up to a senior partner. And I think it's one of the most misunderstood elements of venture capital, actually. This notion that all of the returns are concentrated with the big firms is just factually untrue. Cambridge Associates, who's probably as deep in venture as any group,
As a consultancy, yes.
yeah, they did a report a couple years back that I think really illuminates this issue. So they looked at, for the previous 10 years, what were the 10 highest performing funds in each of those years? So 100 total best performing funds, the 10 best in each year. And so theoretically, a group like Sequoia or Lightspeed or Founders, they could be on there multiple times, right? Because you're raising funds every couple of years. And yet 68 of the top 100 best performing funds of the last decade were first or second time emerging managers, first or second time funds, which is an amazing statistic. And I think the reason is exactly linked to what you just described. I think many funds go through a cycle where in the early days, they're hyper focused on generating outsized returns. You've got limited assets, and candidly, it's much easier to 5 or 10x a fund when you've got a fund that's 50 or $100 million than it is when you've got a fund that's $1 billion. You just don't see $1 billion funds see that kind of outsized returns. And so early in a fund's life cycle, there's an incredible performance focus. But many funds, as they see those better returns, they get into asset accumulation mode. And so you bring on more assets, you hire more people, you move from a partnership or from 1 or 2 or 3 to 8 or 9 or 10. You get less alpha in your portfolio because it becomes more consensus driven. You've got to write bigger checks at higher valuations to start to deploy the sheer amount of capital that you've raised. And by the way, you have a very human phenomenon, which I have seen firsthand, which is, what happens a lot of times when people have seen a lot of success, they start to take a couple months off in the Hamptons or Hawaii, right?
I know, I bump into them there. Not that I go there too much on the inside, I prefer Wyoming.
I've lived it. And so I actually think venture, certainly for many endowments and many, there's some notion of you don't get fired for putting money in the same way as back in the day, you didn't get fired for buying IBM. You don't get fired for putting money in NEA. But the reality is NEA, what is it now? $3 or $4 billion fund. The reality is that is not going to generate outsized venture returns, in my view.
Which the perspective from most investors is you're investing in VC because historically you are going to get quote unquote greater returns than in other asset classes. So why not to some degree swing for the fences? That segues pretty well into my follow-up question. I would say from my experience, I've been in this for 2 decades. I know thousands of single family offices. I've traveled the world to meet them. There are exceptions, but for the most part, most of them are going to have a sub 5%, maybe very well sub 3% allocation into venture.
Yeah.
Explain why that's likely for the long term too low.
Yeah, I think it's meaningfully too low. Well, let me start with more of a qualitative view, and then I'm going to get specifically into the allocation kind of quantitatively in terms of your question. I think, first of all, look, I live it. This is what I've been doing for 20 years. But fundamentally, to me, investing in venture capital is no longer investing in this micro asset class. You are investing in technology. My personal belief is technology is eating the world, right? No matter what sector you are in, whether it's wealth management or real estate or education or whatever, technology is coming to either disrupt you or accelerate your business. And venture capital, these businesses that are being formed all around the world are really a technology layer across all of those things, right? And I think it's sometimes easy to become numb to the technological advancements we've had even in the last 10 or 15 years. You think about things like the iPhone, right? The App Store. You think about the emergence of cloud computing, and all of the SaaS businesses that are built on it. 5G, the massive acceleration of compute power and network speeds. More recently, AI and machine learning, self-driving cars, robotic. These things are all happening. Massive, massive, massive innovations in the last 10 or 15 years for in a large part, right? And it's just a small sample of some. And so when I think about portfolio allocation, Angelo, I think back to a study just a couple years ago that was done that looked at, for the most sophisticated investors in the world, right? Endowments, pensions. If you look at them over time, right? If you go back to 2003, those groups on average only allocated about 2% to VC. In 2011, it was about 3.5%, and more recently, it was about 6%. Okay, that's for endowments generally. But if you look at top decile return endowments, Yale, Harvard, Princeton, truly the most sophisticated endowments in the world. I would argue some of the most sophisticated investors in the world. That number is much, much higher in terms of their allocation. So that number in 2003, it was 4% versus 2% for non-decile. In 2011, it was 8% versus 3.5% for non-top decile. And more recently, it was over 15% of their allocation was going to venture capital. And so what you see very consistently is, I would argue, the smartest, most sophisticated investors are increasing, ramping up their exposure to venture capital. And the reason is really simple, is if you're looking at top 2 quartile, not even top quartile, top 2 quartile venture capital in the last 25 years, the performance relative to all of the public benchmarks is meaningfully higher across really any time period, with the exception of, I think, two quarters in 2023, or 2022, where there was slightly negative. But the reality is that pretty consistently over any time period, you've seen venture capital outperform Russell 2000, NASDAQ, S&P, and many other benchmarks. And it's been one of the, if not the top performing asset class. And so that's why you're continuing to see that push towards venture in those top decile endowments. And I think you're just going to see more and more of it. And I'll say one other thing, Angelo. When I think about I always try to take a look at, like, why is technology accelerating? Why is venture capital performing so well? When I look back to when I graduated from Duke, late 90s, to date myself, candidly, the best people coming out of those universities, the top universities, they were going into investment banking, Goldman Sachs, Morgan Stanley. They were going into consulting, McKinsey, BCG, Bain. That's what the best, most qualified candidates were doing every year coming out of undergrad. That's not true anymore. Right now, the very best people coming out of the very best universities in the world are almost always entrepreneurs going into big tech, going into startups, with a higher degree of frequency than you've ever seen before. There's more technical people building on their own. And those are the kinds of trends that I look for when I think about what we're going to see over the next 10 years.
Well, your timing's perfect, because I was going to ask about trends in 2024. But before I do that, 2 quick points. One, as I hinted at earlier, I know, because I've done hundreds of these, that some of you are like, Angelo, the education's great, it's helpful, but is this also going to include Justin talking about some companies or a bit of his fund and opportunities? I promise it will. Give it probably about 15 or 20 more minutes, but we will. Also, one of our participants, who I do know, Jim, we'll go by the first name Jim, he actually had an interesting comment. When I was saying 3 to 5%, he basically chuckled and said in the comment section, not me. But that did remind me, Jim is effectively self-made. He is the principal. He is the family office.
Yep.
I think when you have a more institutional level family office, the good and the bad, and it's removed from the family, the challenge could be the buying the big blue of the 80s. We're going to play it safe. We're going to be very conservative. The family's already rich. And there is grains of truth to that. I do understand it. What I will state, when you're rich, your inflation is through the roof because you're living more of a luxurious lifestyle. You're buying assets that are going to be greater than general inflation. And over decades, I know that's a long time, but I just came back from Europe, as many of you know, where I interviewed multiple 500-year-old to 1,000-year-old plus families. They worry about purchasing power. I don't know. It's worked pretty well for them. Two of them have been wealthy for over 1,000 years. So I would just, again, a reminder, the principals probably have the most entrepreneurial spirit. I would try to instill a little more of that in the executives in the family office. Okay, that's my little soapbox. But on that note, since you did cue it up pretty perfectly, we're coming off open AI. AI is very trendy. What are we potentially looking at as trends heading into 2024 and maybe shortly thereafter?
Well, look, I mean, I think the one that is kind of unlike any trend that we've seen in over a decade is AI, right? And look, and AI has existed. It's not new, right? It's the notion of, I think, this seminal kind of breakthrough of generative AI is what's gotten people so excited about the category. And I contrast it with Web3, which had a lot of enthusiasm. It still has some, but has had a lot of enthusiasm for some time. And I'm sure some people will disagree with this. I've had some exposure there, but I have largely stayed away from that category. Not because I don't believe in the long-term vision of that technology, but more because I am a big believer in that you can't just be right. You have to be right at the time. Timing matters. And the issue to me with Web3 is that we've had now years and years and years and tens of billions of dollars poured into that, but very few actual use cases that people touch day to day that they can truly say impact their lives. I contrast that very, very much with what we're seeing today in AI. You are seeing consumer applications that are getting incredible traction. ChatGPT is obviously one, but you've got things like HeyGen and other companies that have seen true utilitarian offerings launched and growing and monetizing very, very effectively. You've seen it in the enterprise, right? Every business now has to be asking themselves, how do I leverage AI to improve either whether it's add a feature or functionality to my product, make things more operationally efficient, whatever it is, right? And so it's interesting because AI right now is kind of the one area in venture that's not seeing this massive pullback of interest, and in some ways is in that hype cycle that we saw in 2021. But I think there's a lot there, and so it's obviously a space that, to me, I find I'm spending a lot of time. I've invested quite a bit, but I'll tell you what else gets me excited, Angelo. What gets me exciting too, I take a global perspective, right? So I see a lot of business models that have started to work in places like China that are being ported to other parts of the world. And I'm getting incredibly excited about certain emerging markets. I think India is an obvious one, where you've had decades of a workforce that has become technical, that is highly educated, and that has candidly spent decades building for other people. So US companies outsourcing to India, super high quality, much lower cost developers to build those products. Well, now you're seeing, really, it's been a product in the last decade of more capital inflows there but you're seeing more than ever incredibly talented entrepreneurs spinning off, building for themselves, and building some great companies there, leveraging the learnings of the US and China in particular. And so I'm excited about some of the trends I'm seeing in emerging markets, um, and some of the applications of AI for sure.
Actually, your timing on that is perfect. I'm looking at, and a benefit of being interactive and live as I get to look at your questions. One of the questions from Todd was relative to that I hinted at to begin. Silicon Valley's awesome. It still is king. As an American, sure, it's great entrepreneurship that makes us special, but it's not limited to just the US. So you did
Totally.
mention specifically Asia. Okay, let's jump into that a little bit. There's amazing Indian entrepreneurs that obviously have come to the US. They go to our great schools and they've built or are active in amazing companies. But I've been hearing about India as a country specifically. Oh, it's going to be the largest country. Well, it already is. It's going to be, the GDP within 70 years. Yet there's a lot of stop and starts. Now, again, I don't want to make it a deep economic discussion. That's not meant to be that way, but there's advantages and disadvantages. One, if you wanted to comment on that, and two, in any other, like, how about Europe? I came from Europe. Europe's not dead. I'm sure there's pockets of entrepreneurship that I saw in Germany, in Ireland, in Eastern Europe. Am I wrong?
No, not at all. So first of all, I totally agree with Todd's comment. Like, entrepreneurship is not only not limited to Silicon Valley, it's not even really centered here any longer, to be honest. Like, the way I think about Silicon Valley relative to the rest of the US, or certainly the rest of the world, is probably still the leader in terms of any one given geographic focal point, but its market share has declined precipitously and will continue to do so, because you're seeing more and more and more talented people. Obviously, it was accelerated during COVID, living in other places, more and more people that are technical, obviously communication tools like the one we're using right now that allow people to collaborate remotely. And so I very much agree with that. Yes, I invest globally, right? My fund invests all around the world. We have investments in India. We have investments in South America. We've got investments in certainly in Europe, in Nigeria, one or two actually in China. I'm a huge believer in a couple things as I think about global opportunities. First of all, there are markets like China and the US that often, not always, but often are leading indicators for what you'll see in the rest of the world. A couple of great examples. Live stream shopping, right? So the idea that, for those of you that aren't familiar with what that means, if I wanted to, sell this today on eBay, I'd take a picture, I'd write a description, and I'd start an auction, or I'd put a price on there, and that would be the end of it. With live stream shopping, which started really in China, Taobao Live, it's a company that's really disrupted Alibaba in a lot of ways. The opportunity is much different. So I would then take this, I would hit a button, and I'd be live, just like I am with you. And I'd start to talk about the provenance of the can and where I purchased it and why I think it's valuable, and all of these things that really I can tell the story around what I'm selling, which doesn't matter for everything, but for a lot of things, it does matter. It's why QVC has seen such success here in the States, right? In terms of the old kind of linear TV model.
Of course.
And so that was very successful in China. Well, so I saw that happening in China. I found a company here in the States that was in the collectible space, a company called Whatnot. They were not doing live stream shopping. I put the first money in the company, and then I spent several months working with them about the idea of adding live stream functionality. And they did. And the business started, instead of growing 20% month over month, started to grow 80, 90, 100% month over month, and has gone from hundreds of thousands of dollars of GMV a month to hundreds of millions of dollars of GMV a month, because of the success of live stream shopping. And then now, having seen that, I have invested in similar companies, one in Europe, one in Indonesia. I'm looking at one in Africa right now. And so I very much believe that in a lot of these cases, the group buying is another great example. In a lot of these cases, we as people are actually much more similar than we are different in terms of our inherent wants and needs and desires, et cetera. And so this idea of taking themes and business models that work and finding great entrepreneurs in other parts of the world and helping to back them and figuring out what are 2 or 3 things that matter in that environment, I think is really effective. And so, yes, you have to be aware of the fact that countries like India or Pakistan or Nigeria have different economic and governmental risks associated with them than the US. And certainly that's part of the equation. But you also have to think about when I'm meeting an entrepreneur in India, I'm not holding them to a lower bar than the bar I'm seeing here in the US. In fact, a lot of times, candidly, these are more talented, more technical teams working longer hours, building incredible products. And so if you can work with them and help them on things like go to market, company building, et cetera, I think there's lots of money to be made in many of these other emerging markets for exactly, the reason that Todd kind of highlighted in the question is entrepreneurship is happening all over the world. And it's happening because, first of all, more and more people are becoming technical so they can build themselves. All of these countries that have been outsourced development hubs for the last 2 decades are realizing, why am I building for someone else for $10 an hour or $50 an hour, whatever, when I can go, I know what the model is I want to build. I can actually go build it myself. There's plenty of capital around now to fund me. Let me go take a swing, right? And so that's where I spent a lot of time thinking about that and finding those entrepreneurs all around the world.
Well, I promise this is not planned, but that actually does queue up to my next question, which I would say you partially answered. So what key factors do you look at when investing in, are they really different? The entrepreneur or preneurs, if it's multiple founders themselves, or the company and the idea? Obviously, not every company is going to make it. And honestly, just by the track record, most companies you invest in, or anyone, I don't care who they are, not every company you touch is going to be a unicorn.
That's right. So sorry, Angela, you went out there for one second. I heard the last part. What's
the main factors that you did cover a little bit when we discussed Todd's question that you look at in an entrepreneur or team or the company and the idea?
Yeah. So it's interesting. I would say I look for a few things. First, I really care about, let's start with team. And it's a little bit cliche because everyone says, great team, great team, great team. I actually think the team matters a lot, but I also believe that you can be the best jockey in the world. If you're riding a donkey, it doesn't matter, right? So I think the team matters, but it's not the only thing. So when I think about team, I think there's a couple things I really, really care about. I want to understand their grit. I want to understand what have they overcome to get to where they are. I want to understand what was the inspiration for the company. What was the genesis for the idea for the company? I favor much more entrepreneurs that have come across a problem in the in the day-to-day of life, and it's a problem they experienced and they care so much about, they want to go solve it. And by the way, there are tens or hundreds of millions of people just like them. I like that much more than a McKinsey analyst sitting there and doing a top-down dive of where the opportunity set is. I want to start from, what's the problem that you're solving? What's the solution that you're going to build? So I care a lot about that. It's also why I really gravitate towards people, candidly, maybe first-generation immigrants, people that come from a little less. Now, part of it, maybe I'm biased because I grew up in a very small, kind of humble town in the middle of nowhere, Vermont. And that's been a chip on my shoulder for my entire life. And I love that. So I don't, maybe that's a big part of why I gravitate there. But I've seen that time and time again, that hunger and grit, particularly in the last couple years, really matters. I always ask an entrepreneur the question, if my money is the last money that comes in and the world goes to hell, what are you going to do? Right. And it seems like such a throwaway question, but you'd be shocked at what you learn about an entrepreneur in terms of them quitting versus them thinking through 3 or 4 or 5 things that they can do to extend runway, you know, monetize more quickly, expand a product, whatever it is. So I care a lot about that. I also really think a lot about category defining companies. I want to be in companies creating markets in a lot of cases. I love that wow experience for the first time user, and then it's different, right? So what do I mean by that? Uber was a great example back in the day, right? Most of us still vaguely recall the experience of like picking up a phone, calling a taxi company, them telling you they're coming, and like 15 minutes later trying to call them back and figure out where, like, and the first time you tried Uber, where you picked up your phone and you watched the car come to you, is magic. It's magic, right? Those are the experiences that I want to feel when I see a product, and I want to see it in the data that the users that have tried this product use it a lot and they love it, right? And that metric looks different for different types of companies, but I care about that a lot. So I don't care necessarily that it's growing super quickly yet. I care a lot though that the people that have tried it love it, and there's a narrative around why I can see this growing, and I can give some examples around that. I'll
Perfect.
tell you. What's
Before we
that?
get to, oh, I'm sorry, Justin.
No, so I would say the thing I don't spend as much time thinking about, honestly, is market size.
Hmm.
And not because uh, I don't care about the ultimate outcome, because I very much do, but because I think for many of the best companies, when they got started, the market size looked much, much smaller than reality because they're creating new markets. Uber,
Yeah.
Uber is a great example of that. Airbnb is a great example of that, right? If you looked at what the bed and breakfast market was when they got started, you'd never invest. Snapchat, who would have thought that a disappearing photos company could make any money, much less billions of dollars, right? So I think about a lot about that. Now, with emerging market companies, I think a lot about, I have to think more about uh, government regulatory risk. I have to think even harder around being able to reference those founders and how do I get data points that they are trustworthy and competent and, et cetera, et cetera. I think the point I saw in the chat here just a little bit ago from Jim about U.S. investors should not be providing capital to Chinese venture companies. First of all, I totally agree on this notion of potentially funding our number one enemy. I think that's a very, very fair point. It's been something I've been thinking a lot more about in the last couple of years. I do have a couple legacy investments in companies that are Chinese companies, but we have not made a new investment there in probably 18 months or 2 years. For exactly the reason that you just articulated, which is not because I don't think there's great opportunities, because I think there'll be generational companies that are being built there, but because of the number one enemy kind of risk, and because candidly, I think there's a lot of issues around the trustworthiness of the numbers that come out from many of the companies there. So that's a factor when you start to think about investing in emerging markets and other markets.
There was another question that came in. I'll read it so the audience can hear it. It would be good to address the vintage year power law. This is a great time to invest in pre-seed VC. Talent is more available, and those that are capital efficient.
I struggle saying this because it sounds like because I am in venture and it sounds self-serving, but I really believe it. I think this is a generational opportunity to be
Wow.
investing in early stage venture. First of all, it's so funny to me. So many of the groups that were really excited when numbers were massively inflated in 20 or 21 pull back during times of uncertainty like this. And the reality is that is when the money is made. Now, would I be concerned a little bit about right now having money in growth equity firms where or a stage before that where you've got to rely on growth investors to keep your company probably a little bit right now, because I do think that's going to be pulled back. But for early stage venture, where it takes a little while for these companies to mature and grow, and you're really taking a 7 or 8 year horizon, not a 12-month horizon, it's a no-brainer. You've got more talent on the street starting companies. You've got incredible macro trends, things like AI that I just talked about, that aren't just the next trend. This is a trend that I think looks different than any trend in, at least in my lifetime, with the possible exception of, the app store kind of explosion, 10 to 15 years ago, right? But I think it's bigger than that. So when I think about venture, I think that the vintages, even in 2020 and 2021, will ultimately perform well relative to other asset classes because of the macro trends that I've talked about. But the power law that I can't remember who pointed out, but is exactly right, is this vintage right now, when so many groups are pulling back and there is so much talent out there building, is exactly when you want to be in those companies and go hunt the best entrepreneurs.
Bless you. Oh, great. I think I have two final questions. Then I know we're running a little bit late on getting to what Justin's up to now and getting some insight on that, but that's getting very close. I think you just named one in a certain sector, but what would be a downside to current VC investing?
Look, the downside for VC investing is, to me, always the same, which is, again, assuming that you've picked a manager that knows what they're doing, is the illiquidity, right? Is the reality is that there's a period of time that your money's at work. I would argue behind the best entrepreneurs in the world, but it's at work and it's not accessible in the same way that certainly public markets are, many other investments, even real estate is, much easier to take money out of or sell or kind of liquefy than venture capital. So I think that's the downside, is you've got some period of time where that money is not touchable. That being said, what you see is that across a portfolio of opportunities, you're going to have some companies in the earlier stages that get liquidity, right? Like, I got a fund that's 2 years old. We, I don't know, 9 or 12 months in, we sold a company for 8x after a 6-month investment. We're selling one right now for a 10x. That's, we've owned for about 14 months. Now, those aren't the big, those are not the companies that I think will ultimately drive the massive returns. Because to me, the companies that I'm looking for are the ones that, return hundreds X, thousands X, not 5 or 10x. But you have some cash flow in the first, few years. But the reality is that you don't want to sell your best performing companies, Angelo, until you want to let them run. You want to let your best companies become public standalone companies and then distribute stock to LPs. And that can take a while. So that to me is the downside.
And I believe my last question before we get into a little bit of some of the fun stuff, and a little bit of a soapbox, and you may agree with me, the banks are not going to like me. I hear so many family offices that are so reliant. I get it. You need cash management services, you need lending, and you need multiple banking relationships. I'm the first one to understand that. But to rely on them for private deal flow, for the most part, and venture capital opportunity, It's wickedly conflicted. It could be very expensive. And if they have direct opportunities, a lot of the times it's pre-IPO. A lot of the potential for alpha has been kind of out of it. And their fees could be really, really high. Like, I'm sorry. I know I'm considered to be a little harsh to some family offices. Don't be lazy. Be disciplined. Hire talented people if you don't have the capability, and that's fine. And then allow them a level of freedom to do their thing with expectations of greatness. Hold them to a high bar. Just because they could call up the banking relationship and get some deal flow and opportunities doesn't mean it's optimal or it's good. What do you think, Justin?
Well, first of all, before I address this, I have to say that I love that Todd is on the Duke Library Board. So would love, I just saw that note, which I bleed Duke Blues. So I would love to talk at some point. Yes. So I have a very strong perspective on this, having worked with many family offices over the years, and seen different approaches they've taken to venture. The first thing I would say is, this may seem harsh and it may offend people. And I did banking. I worked at Morgan Stanley for a little bit as an investment banker. But I would say this, which is, if a group is relying on investment bankers to bring them private market deal flow, they are going to lose money over time, unequivocally. There's an adverse selection problem, fundamentally. Now, I'm not talking about necessarily the like pre-IPO, this company is going public in 2 months kind of thing, or now. But this idea of using a bank for Series B, Series C, Series D, is almost always a bad sign. The best entrepreneurs in the world find ways to get in front of money. They don't need investment banks. And like, I can just tell you, across all of my companies, historically, that's been true until the very late stages. And by the way, the dirty secret is that at the very late stages, when they do go to the banks, often, even if they're great companies, that deal isn't actually that great anymore, because it's been priced fully. So,
Yes.
so in those situations, I just tell people all the time, like, I think it's a really bad idea to be investing in I have a lot of respect for the people at Goldman, but the deals they're going to bring you are not the highest quality deals in the venture capital universe, period, full stop. And so then you've got to ask yourself, I think, as a group, do you have the capabilities internally to do venture investing? I'd say some groups have it at the later stages. I still think it's hard. I think the reality is that 99% of, again, I hope I don't offend people, but like, family offices do not have the capabilities or the network or the focus to be top decile, early stage, particularly venture capital investors. In the same way, if I was trying to do real estate tomorrow, or being a a debt buyer, like, those aren't my spaces, and dabbling in spaces where you've got some of the most talented people in the world focused on them is, to me, a really good way to lose money. And and so I see it all the time. I get family offices in Minnesota sending me some deal that they got sent to them by a buddy, and it's like, hey man, like, I saw that 5 months ago, and everyone's seen that, and there's a reason no one's investing. And it's just hard. It's not an intelligence thing, Angelo. It's just, every great VC makes mistakes early in their career. That's how you learn. That's how you develop pattern matching. But when you're only seeing a handful of those a year, like most family offices, you just don't have the volume and the experience to make those adjustments that you need to make to get, and the network to get into the best companies in the world. And that's where the outsized returns are delivered. And so my personal view is, if you are a family office and you're actually interested in technology and venture capital, find a handful of groups. Personally, I think emerging managers, like I invest in, I've got probably a portfolio now of 15 or 20 other emerging managers I also invest in that have, different areas of focus. Find a handful of emerging managers, invest with them, and spend lots of time with them. Literally, do a monthly or bi-monthly call where you're going into the portfolio, understanding how they think about it, like, and get to figure out which of these groups do you really align with, which ones do you believe in the most, and then as you increase exposure to them, find ways to co-invest alongside of them, not in later rounds, right? I think there's this, the fact that Andreessen brings its LPs a deal 2 rounds later is not that sweet. It's like you guys are very misaligned, right? I'm talking about find ways to build relationships with the emerging managers in your portfolio where when they're writing, a $3 million check out of a $5 million round, there's room, or they're writing a $500,000 check out of $1 million round, there's room, right? And you've been building a relationship, you've developed trust in how they think about the world. But that's how I would personally, if I wanted more exposure, I would do that, not be spending time trying to pick individual deals, and candidly, not be spending time, early on doing SPVs until I had that relationship and had that trust.
Makes a lot of sense. So first of all, a shout out to Jim. Jim, you're really spitting out some knowledge in your interaction today. I love it. For those of you, Jim's a great investor. I've known him for well over a decade. He was an active member back in my days, being the founder and longtime CEO of Family Office Association. Jim, we got to get you back in the flow in terms of what I'm doing now. And I'm actually saying that seriously. I like to joke around a lot too. I'm a stand-up comic at heart. I know it's hard to believe, everyone, but maybe like Stephen Wright from back in the 80s, very straight-faced. But being a member and being active means you interact. You travel with me when I go around the world. You have an opportunity to meet peers that are just simply amazing. And if you don't get one good idea that you don't act on from being a member of what I'm doing, then I guess I let you down, but you kind of let yourself down too. I've been around this community for a long, long time. I'm old. I love it. Made mistakes, probably will make some more moving forward, but I'm so fortunate to have a great network and some great people around me, including moving forward. Okay, here's what we're going to do. It's a pinch off the rails and a little different, but hey, I'm me. That was an incredible 55 minutes of deep intellectual capital. I think I am going to take parts or all of that and share it with a larger audience from an educational perspective on VC. What we are going to do in 1 more minute, so I could do a clean break on the video, I'm going to go quiet for 2 or 3 seconds. I know that's hard for me to do. And then we're going to go into the shorter, I promise shorter, part 2, where basically, Justin, you seem damn amazing. Like, what are you doing that in a private Zoom that's not going to be public that you could talk about? Before we do that, for those that more publicly say, wow, this was amazing, I want to reach out and learn more about Justin. In a short 1 minute, how can people learn more and reach you? Then we'll get to the 20-minute ending part 2.
You want me to go now, or you want me to wait for the break?
Do it now, because people that see this publicly, this will be it for them.
Yeah, I think, certainly feel free to get connected to me through Angelo. But what I'm doing right now, I run I'm happy to leave my email is jcaldbeck@gmail.com. Is an easy way to reach me, jcaldbeck@gmail.com. But yeah, I've been running a global seed fund for the last 2 years. I work with a number of multifamily offices, really globally at this point. And I love it, man. I would, anyone that's interested in just talking about venture, even if it's not about my fund, I love it. I believe in it. It's where I spend all of my waking hours, is trying to hunt the next generational company. And that to me is really rewarding, and it's what I love doing. And so the funds perform very well. It's a top decile performing fund for the vintage right now. Really, I feel really, really good about it. I will down the line be doing another fund. I'll be doing this for a long time. So happy to talk about that, or happy to just talk generally my perspectives on venture, or kind of how other people are thinking about it anytime.
Incredible. That's very valuable. And for the more public portion, my brief ending, that was a great discussion. I hope a lot of you enjoyed it. I look to definitely do more. I'm a big believer in entrepreneurship and in venture. So this is great for me. It's something that I love to do. And again, I've been at this a long, long time. And my model, from even what I did back in the day at Family Office Association to even my public media platform now at Family Office TV, to my membership community. And I love education. I love to teach. I like to hope I may know a thing or two about single family offices. So as I travel the world and know thousands of them and create them, I love to do that. And I love to educate through my family office masterclass. But I would be foolish if I didn't keep my mind open, adapt my model moving forward, including for my members, of incredible introductions that I could make. I come across, and I don't deserve this, by the way, but I come across partially through the 2,000 plus single family offices that I know, and an incredible network in Europe, to some degree Asia, definitely in Silicon Valley and other parts where I get incredible opportunities. Sometimes they're directs, sometimes they're all sorts of asset classes. You need to make your own decision, but interact with me with what I'm doing and opportunities that I have moving forward. I promise you, it'll be quite a ride, and it'll come across some intriguing, deep education that I don't think practically anyone could give you in terms of like what I could. Pardon the arrogance of that comment, but also opportunity in a variety of different ways. So stay tuned. Things are changing. Follow me on all my socials and reach out. I think you're going to be in for a surprise. This will be an incredible year. On that note, shockingly, let me be quiet for 2 or 3 seconds so I could do a break in this video. We're going to get to the relatively short part 2. I thank you all on the public side for viewing or listening in, and look forward to the next time.